Welcome, this is Javiii from JT Empire. This class is going to talk about technical analysis. Let's do this. I know a lot of people out there very new to trading are beginners. They want to know some basic terms on how to analyze a chart the right way. In this class, I'm going to talk about how to analyze your chart to get what we call a bias, which is pretty much where we expect the market to go. With technical analysis, there are two things we actually focus on. We have market structure, and also we have how price reacts to the structure of the market. In market structure, we identify key levels. The key levels can either be support or resistance. Now, support and resistance are very basic with trading. Support is essentially what keeps price up, and resistance keeps price down. You can look from the perspective that you walk on the floor in your house. The floor actually keeps you upwards. It's the leveling out the force that it exerts on it. From a market view, a support should be below price, so it keeps price upwards. And the resistance now, if you're walking in your house, let's say you jump to touch a ceiling, if you should touch said ceiling, then the ceiling will actually keep it downwards. So that's essentially what we look at: the support and the resistance. One keep price up, one keep price down. So we're going to look at different types of support and resistance. Now, you have ordinary support and resistance, you have supply and demand zone, and you have trend line. These are all type of support and resistance. Now, you have a lot more. In the interest of time, I'm going to talk about these three. Over on the right side, you will see where you have something, let's call it a squiggly line. It's a line, going up and down, forming like sort of waves. The line is a representation of the price on the chart. Down here you see a rectangle which has a S in it. That's my support. What we do when we identify these key levels of structure is that we look for 2 or more touches. So for our support, we need at least 2 touches to identify that as our support. You have 1, 2, 3 right there where the market rejected around about this area, so I identify that as my support. So I drew a rectangle now to mark off that and call it S. That's my support because it's keeping price up. Each time the market comes to this area, it rejects and then pushes upward. So you see, touch here, push up, touch here, push up, touch here, push up. So that's why I identify that as my support. Now the resistance is the opposite. Now that keeps price downwards. So how I got this to be my resistance is I got 2 or more touches. So I need at least 2 touches to consider it a resistance level. So I have 1 here, right here, and 1 right here. So that is 2 places where the market rejects that area. So I consider that my resistance because it's keeping price down. Each time the market comes to this resistance, it pushes price downwards. So it come to here, push it down, come to here, push it downwards. So that's my level of resistance. That's an ordinary view of it. When it comes down to supply and demand zones, I have price represented as candlesticks. A supply zone is where you take the buy candle before the sell move into consideration. Your supply zone is generally when the market is high. Demand zone is when the market is low. If you look at the perspective of retail, let's say you go to a shop and you look from the perspective of buying and selling goods. Let's say there's a lot of chicken in supply right now in the world. You have billions of chicken and like 10 people in the world. Then that chicken is in supply, which means that the price will then fall. You have too much chicken in the world and not enough people to eat it. So the price where it would cost like $100, now it costs like $10. So the supply zone is when the market is high to push the price downwards. The demand zone, using the concept of the chicken now, you don't have enough chicken for the amount of people in the world. You have only 10 chicken and billions of people in the world. So imagine the price of those chicken. You have a lot of people that will buy it, so it raises the demand of those chicken. So the demand zone will be the support area, right? And the supply will be the resistance. So the supply is where you have too much chicken and it pushes the market down, and demand zone is where you have a lot of people that are interested in having the chicken. So it will push the price upward. So how we identify supply and demand zones on the chart now? The supply zone will be the last bullish candle before the sell move. So you're taking the whole candle into consideration from the wick to the next wick. You're expecting that this now would be your level of resistance coming across. Please notice that we draw the box up here for a resistance. We draw another box right here. This is our resistance. So whenever the market comes back to test this, we're expecting the market to push the price down. The opposite now, the demand zone, is where we take into consideration the last bearish candle before the buy move. And we're going to mark off the level of support like this. We take into consideration from the top wick to the bottom wick. In the event that the market comes back to test this, we expect the market to rise higher. The trend line now on the other end is what we call our dynamic support and resistance. The first two that we look at, they are horizontal lines that we draw on the market. But in this one, it is a line going up like a slope. So the trend line is what we call it dynamic support and resistance. And when the market is in an uptrend, creating high highs and high lows, we draw a line like this as our trend line. It should be a straight line coming up. Each time the market come and touches that line, we expect it to buy and go higher. Now, just like the regular support and resistance, we need at least 2 touches to mark off a trend line. Now, you can't have one person with a trend. You need 2 or 3, maybe even 5 people to get a trend. You know, trending close, etc. It can't be a trend with just one. So you have this right here and this right here. You could probably use that as your trend line, and then when this come into play, you could say, alright, it's building up. So we have 1, 2, 3 touches. That is my trend line. And then the opposite now, with the downtrend, low lows and low highs, draw a line like this, and that would be our downtrend line. Or dynamic support S, our dynamic resistance R. Now, when you're analyzing, you draw the support, you draw a resistance, you draw a trend line, you need to understand how price reacts to these when you're doing a technical analysis. And that's how price action comes into play. And with price action, we take into consideration the candlesticks, the rejections to the key levels, and also the volatility of the market. So right here, we have some candlestick formation. So we have marbles, the doji, we have spinning top. I will share with you guys the candlestick Bible. You will see it down in the description or down below in the chat. You can then read up and understand what's happening within each of these candles. The Maribozo is a high momentum candle. This is a bullish Maribozo, meaning it's pushing upwards. It leaves little to no wick at the top and at the bottom. So it's high volume, high momentum going upwards. It's a full candle. Small wicks at the bottom and small wicks at the top. It shows high pressure into a direction. Doji is an indecision candle. It has a long wick at the bottom and long wick at the top with a small body in the middle. Means there are a lot of buyers and sellers at the time, pushing the market up, pushing the market down. It's indecision. Possible reversal. Spinning top is similar, but it has a bigger body than the doji. It leaves wick at the top and at the bottom. The spinning top also indicates indecision. We have a lot of buyers and you have a lot of sellers. Buyers pushing the market up, sellers pushing the market down. These two are indecision candles, indicate a possible reversal. There are more to candlesticks, so you guys do your reading. When we talk about rejections to levels, now we have key levels of structure, resistance and support. Right here we have a support, just a regular support, and the market sell, touch the support. Apart from you see the rejection here, draw your support, you have 2 touches. You see a doji right here, which shows you something. Remember, it's a indecision candle. We have buyers and sellers into this candle, so there's a possible reversal. Then upon seeing like a Maribozo candle pushing the market upwards, you could say, alright, this could be a possible trend reversal. This is high momentum pushing the candle upwards, so we're no longer in a sell or a downtrend. We could possibly in an uptrend now. The rejection to levels shows you a lot. What is happening, the formation of the candlesticks at the level shows you a lot of information. You just need to understand what it is telling you. We have a resistance here with small candles coming up, showing that the buying pressure is diminishing. We have our resistance. The buy candles are small coming up to that. Then we have a huge sell candle with high momentum coming down. Look like a Maribozo candle, which engulfs this candle right here, which shows you something again. The buying pressure got smaller as it goes to the level, and then the selling pressure pushed the market down. Possible sell reversal or trend reversal. Now we have rejections to this level. Now we see long wicks pushing or bouncing off of the support, tells you something again, that there are a lot of buyers at this support that could potentially push the market up. All these things that I mentioned helps with your bias, but market structure and price action are about these levels of structure. You need to take into consideration, market structure is very, very simple, but you need to take into consideration what the candlesticks are showing you on said levels and what the formation of the candlesticks mean to actually help with your bias. Now, of course, I've been very, very basic, telling you the basic things that you need Now it's just pointing you in the right direction as to what to study and what to look at. That's my aim right here doing this video. The volatility of a candle just relates to how fast the price moves from point A to point B. Some markets are volatile than others. So with that said, this is Javiii. We're going to analyze a couple of charts. Peace.